language interpreter this morning is Tobias Omonde. We are here to have a conversation about money matters and how you would be able to stretch your shilling. And guest in studio this morning is David Getao. If you remember, we had him last week, and we were talking about cash preservation and how you could preserve your income so that you can spur its growth. And today we are still in the same confines, but today we are breaking down how growth. We are basically talking about growth, doubling your money over time through shares and growth property. What does this mean? Last week we spoke mostly about we spoke about dividends. We spoke about government treasury bills and the likes. Today we're going to be discussing shares and growth property and how you could be a part of that journey and how you could invest in such investments. Mr. David, good morning, and how have you been since last week?
I've been well, thank
Yes.
you. And thank you again, once again, for inviting me to this show. It's always exciting to get to be called again.
Yes.
Yes.
Amazing. So we're going to start it from a point of when somebody hears doubling your money through shares or property. For the first time, what does that really mean in practical terms? If I'm just hearing it for the very first time, practically, what does it mean?
It's a fairly simple concept,
Yes.
so to speak. But essentially that's it, whereby you're looking at starting at a particular point with a specific amount of capital,
Yeah.
but over time, ensuring that that capital you invested, at the point at which you're exiting or you're selling that investment,
Yeah.
you're essentially selling it at a higher price than what you acquired it for. Yeah. Essentially, when you're looking at growth, there's the issue of your capital.
Yeah.
In the sense that, yes, you put in some money, for example, 100,000, but what most people should appreciate is the fact that that 100,000 that you put in as capital fluctuates in value, both upwards and downwards.
Yeah.
So today you put in 100,000, tomorrow you might find it at 98,000 and that, or even just flat.
Yeah.
Or even it could have appreciated a bit. But in the long run, what are you looking at? You're looking at an average return that is consistently on average going up.
Yeah.
So essentially you're looking at capital gains. Typically you would not be looking at any cash coming in the interim. Yes, sometimes that does happen, but that is not the primary focus. The primary focus is buying low
Yeah.
and selling high. So basically capital gains.
Yeah.
And the key phrase there, or the two words that are very important, is over time.
Yeah.
It is not an overnight
Success.
success story. It is over time. So patience is very key.
My next question was to be you defining growth, but I feel you have sort of touched base on it in that explanation that you've given. But are there any ways that you would extrapolate and explain growth further?
Not really. In simple terms, you're looking at capital gains. For example,
Yeah.
when we talk about investing in a business as part of your growth strategy,
Yeah.
that could be investing in a business that is privately owned, which maybe you start, you and friends, or you and the family, or even just yourself.
Yeah.
But the whole idea of even you starting that business is at one point to sell it at a higher price than what you started
It
the
with.
business with.
Yeah.
So we're looking at capital gains. So likewise, if you're investing in a business that is trading on some recognized securities exchange, like the Nairobi Securities Exchange, so you're looking to buy the share of a company, let's say at 20 bob,
Yeah.
and over time, being able to offload that share and make your profit and realize your actual profit in the sense of share price
Yeah.
increases. Yes, you might get dividends in between. You might get dividends in between, but dividends is not the major focus. The major focus is the difference in price from the beginning and what you're exiting at the end.
Yeah.
And that applies to property as well. It's still buying low and selling high. Of course, The strategies will be slightly different, but for me, I try to simplify investments in the sense that they all work pretty much the same way.
Yeah.
Yeah.
And then how does investing in shares help someone build wealth over time? But even before we speak about the shares and how they help, what is a share? Basic. Somebody might be wondering, wanaongelea mambo ya shares ni nini? Yeah.
When you put money into a company,
yeah.
Essentially what you're exchanging that money for is a share. And a share simply means that now you have an ownership stake in that company, and being an owner in that company then gives you certain rights.
Yeah.
The right to attend meetings, the right to appoint directors,
yeah.
The rights, of course, even sometimes the rights to appoint key employees. But of course, the biggest right there is the right to the cash flows of the business,
yeah.
in the form of profit.
Yeah.
So when the business makes profit, as an owner of the business, as a shareholder in the business, you have a right to those profits, which will come in the form of dividends. However, if the business is not doing too well,
yeah.
you also have to share in the losses. Yes, and it's a very simple concept. Look at it like your own personal budget.
Yeah.
You have your income and your expenses. What is left over as a person is what you're going to use. In a business, it's the same thing.
Yeah.
It's what has come into the business. The business has paid rent, it has paid salaries, etc. So what is remaining after that? Your net profit, even after paying taxes, after paying all your loans. That is what I mean by the cash flows. You have a right to those cash flows of the business. And of course, that right may not be absolute, because depending on the structure of the company, the directors may have to declare that, okay, yes, we've made X amount of profit, but we can't give everything out. Let's just give a portion. We reserve a portion for growing the company.
Yeah.
But essentially, at the end of the day, it is the net profit that you're looking at. Yes.
There is a fear that the stock market is only for the wealthy or the very educated. How true is this? But even as you're thinking about that question, where then do we find these shares? Because we have understood what a share is. Where do we find them, and how do we get access to them?
Okay. In terms of whether you need to be an expert or not,
yeah.
That is basically a myth. You do not have to be an expert to invest in shares.
There are those people who are good at spotting stocks, the likes of Warren Buffett.
They use very simple principles. And let's break down buying shares like buying clothes.
All right.
Because essentially, we're talking about a stock market or a share market.
Yeah.
And whether you're buying clothes in Gikomba or you're buying vegetables in Marikiti, after all, it's a market. And all markets essentially work the same. So the key question you should be asking ourselves is, okay, when you go and buy clothes, what are the two things that you're essentially looking for? One is quality.
Yeah.
You're looking for clothes that will last you a long time. You're looking for clothes which will give you value for money. Then secondly, you're looking at price as a second determinant.
Yeah.
Price means you're looking at buying that clothing item at a discount. So if we translate that into how you go about making an investment decision as to what share to buy, you go through the same process.
Yeah.
Essentially, you would pick a company. But even before picking a company, the best route to go would be looking at the big picture first, trying to figure out, okay, which industries or which sectors of the economy are going to thrive within my investment horizon.
Yeah.
And then now you narrow down. So maybe you have 12 industries. You can say tech, agribusiness, education, health, ECC, and you come up with all these, and then even real estate. And then now maybe you then say, okay, where exactly do I have some expertise, or where can I develop that expertise? And let's say you assume maybe real estate. Then again, you ask yourself a very simple question. In real estate, who is going to thrive? And you keep narrowing down until you get to a point, okay, I want to be the owner of a business that probably manufactures and sells cement. So when you get to that stage, you have three options. You can start your own cement factory. You need billions of shillings to do that. You can either go to a privately owned company that is manufacturing and selling cement, of course, and ask them, the shareholders, hey, can you sell me something? Again, the most likely answer will be no, because they're also seeing the same thing you're seeing. So your third option is, okay, let me go to the public. And by the public, I mean, let me go and look for a company that is trading on the public, where shares are easily transferable, where I can buy shares. And then now you go and look which companies are trading on the stock exchange that manufacture and sell cement. That is typically where the first dilemma comes in. Because you'll probably go there and find 3 or 4 companies that don't do that work. So when you're faced with that dilemma, very simple. Revert back. Default
to
setting,
buying clothes.
You're looking for a quality company that is selling at a
cheaper price.
At a cheaper price.
And
when you're looking at a quality company, there are typically, to put it simply, 4 things that you look out for. 1, what is the board and the management team like? Do they understand the business? Who are the individuals running that board, in charge of that company? Do they understand the business? Because these are the people who are in charge of coming up with strategy, the board in terms of approving that strategy, and then management executing that strategy. That element of the board and management, what we call corporate governance, has become the most important kind of like factor when you're looking at the quality of a company. However, it is the most subjective. The other thing when you're looking at quality of a company is, are they actually making any money? Especially if you're a rookie. Yes, we have investors who invest in businesses that are making losses, but when you're beginning your journey in the stock market, it's always good to pick out companies which essentially are making money. And that is not hard to see, because remember, it is just like your individual budget. What came in, what went out, what is left. Essentially making money that is sustainable. The third thing in terms of quality, you're looking at, yes, do they have a product or a service that is relevant? And then fourthly, you're looking at, yes, is there a significant market for this product? So that becomes your first criteria on how to determine which particular stock to buy. So if you're looking at, let's say, the cement sector that we decided on earlier, and you have 3 companies, you all subject them to those criteria. And if they fail on even just one criteria, you don't consider it. So the first thing that you do is look at quality. And you first look at quality, then only do you go to price. Now, price is where it gets a bit tricky. Price is where you may need the services of the investment analysts who are essentially employed by investment banks or stockbrokers. Those are the guys who will give you objective advice. But the thing to tell them is, okay, you have done an analysis of a certain company. You think it is worth this much. Or you ask him, what do you think it is worth? Based on your mathematics, based on your theoretical mathematics. And then you compare that price to what is happening in the market. If the analyst thinks that this share is worth 10 shillings, but in the market it is trading at, let's say, 7 shillings, obviously it is trading at a discount. So the decision should be to buy. If, however, the analyst thinks that should be trading at 10 shillings based on his mathematics, but in the stock market it is trading probably at 13, 14 shillings, that means it is trading at a premium. So the decision there is to not to buy, or if you have it, to sell. So essentially, you're looking at 2 pairs of jeans. One is they are both the same exact quality. One is at 1,000 shillings, the other is at 1,200. You just go for the one that is cheaper.
Is cheaper.
There's
so many things that you have introduced in that answer, and we have time to dissect all of them. You have spoken about a stock exchange market. Now let's graduate the conversation there. What is a stock exchange market?
Okay. Let's go back to our default setting in terms of shopping. Remember, this is a market. A market is simply a convenient place for buyers and sellers to meet. So the stock market is just a convenient place for buyers and sellers to meet, but the commodity in that market is ownership stakes in companies, meaning shares. Marikiti is a convenient place for buyers and sellers to meet, but the commodity is vegetables. So that is essentially a stock market. And one of the myths is that it's only for the big boys. Again, that is a myth because it's a public market. anybody can access it.
Yeah.
Yeah.
When you say anybody can access it, now let us talk about access. You've talked about investment bankers. You've talked about investment analysts. I am Hubbard. Let me use the most used example. I want to buy shares in Safaricom. I have 1,000. Okay, 1,000 bob might be little. Let me say I have 10,000 Kenyan shillings. Where now do I go? How do I start moving to buy shares in Safaricom?
Okay. The first thing that you need to do is go to a stockbroker or an investment bank. These are licensed entities to help you access the market. And then you will open what they call a CDSC account.
CDSC?
Yes, Central Depository and Settlement Corporation account.
Yeah.
This is the central registry that basically holds all your shares on your behalf. Because we are no longer in the days where you had to have a physical piece of paper to prove ownership. Everything is electronic. So you go to the stockbroker, open a CDS account. And based on now your discussions probably with the investment analyst at the stockbroker, then now you can decide how much you want to put in. Once you have the account, you'll be given the account number where you can deposit funds. As an individual, so you deposit funds, and then now you give instructions. Please buy me X share. I have put in 1,000 bob, so please buy me worth, let's say 500 bob.
Yeah.
And it is the work of the broker to go into the market and get you those shares from a seller.
Yeah.
You mentioned 1,000 bob being too little. Again, that is what I would call a myth, because you're saying, essentially you're saying it is for the rich. It is not for the rich.
10,000.
It is not for the rich.
Yes.
Now, the reason I say that is because the minimum number of shares you can buy is 100 shillings. Oh, sorry, 100 shares.
Yeah.
So if a share is trading at, let's say, 1 shilling, you just need 100 bob.
Yeah.
There's some shares that are trading at 50 cents. You just need 50 shillings.
Yeah.
That's not if we don't count the transaction costs.
Yeah.
What is important is what we discussed in the earlier session.
Yeah.
That being successful financially is all about behavior. It is all in the mind. And the behavior here that we're talking about is discipline, which is very hard to teach.
Yeah.
And discipline eventually leads down to consistency. So if you want to be a good investor in the stock market, you just need to be consistent. Haba na haba, ujaza kibaba.
Yeah.
All the stock market gurus, including the works of Warren Buffett, and even the Kenyan gurus in the stock market, the big boys, all started somewhere.
Yeah.
And for them, if you look at all of them, it was the issue of being consistently in the market, constantly buying over time. So you're buying these ownership stakes over time, and over time, your money is also compounding, it is also growing. So later on in life, you find you have a big portfolio, but you must start
somewhere.
Now, that is one route.
Yeah.
You can go directly. Remember, all investments, you can either go direct to the market and buy, or you can also go through a collective investment scheme. Now, if you decide to go through a collective investment scheme, and just to recap, a collective investment scheme is just an investment vehicle that pulls resources together. Because, of course, with more money, you're able to do bigger things than you would not ordinarily be able to do by yourselves. So we have collective investment schemes which specifically are designed to buy shares.
Yeah.
And they're called equity funds. So if we go the route and say, okay, yes, I only have 1,000 bob, how much can I do with 1,000 bob? Because if I went direct with 1,000 bob, I would probably just buy probably one company's shares, and very little. The other route is, why don't I take this 1,000 bob and go and look for a collective investment scheme whose objective is growth and whose objective is basically buying shares, and we call those equity funds. And the good thing with equity funds is that when you put, let's say, 1,000 shillings, An equity fund is a pool. It has different stocks in there. So you become an owner indirectly of all these different companies. You get instant diversification. You get the professional management because maybe you don't even have the time to actively manage these investments. Look at the newspapers every day.
Yeah.
Try and do this analysis. There are guys who can do that. So you can either go directly or through what we call an equity fund. Yeah.
We've seen, I have seen in the United States that trading stocks is as easy as going onto your phones, and access is basically very simple. Is that something that is also possible for here in Kenya? And I don't need, because what we're not saying that the investment brokers also, there are fees that they're going to charge you because they're doing the job for you. At what level will I need to develop to be able to trade on my own behalf?
Okay. Going directly does not necessarily mean that you won't use the tech, because with time we've gotten tech.
Yeah.
But even in Kenya right now, even as you're using tech, and then you place your order on your phone,
Yeah.
that order still has to go through the broker. So
Because
eventually the broker is the interface.
Yeah.
Yes.
Yeah.
So it doesn't make a difference whether you actually went to the broker and gave him written instructions,
Yeah.
or you, because
Use
even
your technology.
all these investment banks, they all have apps
Yeah.
where you can buy and you can sell. So the only difference now is that instead of giving written instructions and filling in a sell order or a buy order form,
Yeah.
you're just filling it online, but it has to go through
Through the broker. Because the broker now has access to the larger market and they're able to identify
Yeah, yeah.
these products for you.
Yeah.
Then what is the difference between short-term trading and long-term investing when it comes to shares?
Now, one of the things, and if you recall what we talked about, growth, doubling, tripling your money over time.
Yeah.
There's a fundamental difference between the short-term trader and the person who is investing for the long term. The short-term trader is basically speculating, which is essentially guesswork, because share price movements are random.
Yeah.
Okay, it's just saying, oh, where will this thing be? Maybe
Yeah.
it will be at 10 shillings tomorrow, today's at 9. That is essentially guesswork.
Yeah.
Because remember, shares go up and down, up and down. What we're looking at is eventually, in the movement of up and down, what are we looking at? Eventually, the average movement should be up. So my recommended strategy would not be any short-term trading. Short-term trading also has its own disadvantages because of buying and selling.
Yeah.
Their transaction costs. Remember, you're taking your vegetables to the market. You will have to pay fuel, loading fees, etc. And then you have to bring that van back.
Yeah.
If you go and take small things
You're
to the
making
market,
losses.
you're making losses eventually. So just be there for the long haul. That is how businesses work. Because if you look at it even from a private perspective, you will not start your own private business now. 3 months down the line, you want to sell that business to move into another business. For you to make decent money, you have to be there for the long haul. The ups and downs, the calamities in lives or in business, economic cycles, the times when the economy is good, business is booming. The times you say, hey, biashara hii mwezi imekuwa mbaya, that means the value of your company is actually dropping. So you have to be there in the long run. Yeah.
I think we've exhausted the shares conversation, but if there isn't anything, if there is something that we haven't exhausted, could you touch base on it? Because when we come back from the break, I want us to switch our attention to property.
Okay. I think just to summarize the issue of investing in shares in stock market, the only thing I would advise you is, or I'd advise our viewers is that, yes, go and open an account, no problem. But make sure, because all these brokers are the same, okay, in terms of providing you a market. But you should ask those brokers, what extra value do you provide to me as an investor? Do I have access to your investment analysts? Can you put me on the mailing list? So that when these investment analysts produce their research reports where they have done analysis of these companies, of these industries, how do I get access to those? Okay? Typically, when you put on a mailing list, you will receive a lot of information which might not be necessary because you'll receive information on a day-to-day basis. But there's also information there which is key. Because remember what we said about investing is that what you don't know, the notion of what you don't know can't hurt you, but in investing, what you don't know can actually hurt you. Information is key. So they will give you all this information. It's just you to decide, okay, in the evening, I will get a stock price list. I will get a price list for bonds. I'll get a price list for derivatives. All that may not be necessary. But in the morning, you'll also get news, summarized news, which is good.
A CEO has changed. There is a scandal here. How does it interact with the share that you hold?
Thank you.
Yeah.
Perfect. So at least they will give you information or news that might have an impact on a certain company or on the economy or anything like that.
Yeah.
But most importantly, you want to have access to those research reports.
Yeah.
And also, once you get the research reports, are you able to interact on a one-on-one basis with that investment analyst?
Yeah.
So if you're going directly, make sure you make your investment, that is the investment analyst, or they call research analysts, your best friend, because that is the guy who will guide you. And the two questions you're going to ask him are, can you find me a quality company that is selling at a
Lower
price? Period. And that is his work. Yeah.
All right. We're going to take a break. When we come back, we're going to be coming back with property growth through real estate. The first segment was talking about shares, and I hope now you are conversant with shares. We've talked about the stock market and what it means. Basically, it is just like Yogi Komba, but the difference here is that you are trading, you are buying shares in companies. Keep it Science TV, and we're going to be back.